You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that music means it's time for a new episode, indeed a new year, of Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the old Options Insider Radio Network, and we've still got quite a host. This January, it's 9 years of archived quality options content for you guys over here on the network across our broad array of programming. It's not just Vol Views, folks. There's a lot of other shows out there on the old network you guys should check out, and the easiest place to do that is, of course, the aforementioned optionsinsider.com. Check it out over there. All of our breaking news on the options market, unusual activity, a lot of volatility rundowns as well, hot options reports them throughout the day, et cetera, et cetera. And, of course, top left corner of the homepage is where you'll find the Insider Radio Network link. Click that, and you're off to the races. 9 years, thousands of hours of content at your fingertips. Great guests, great discussions, great debates, great nonsense. All of it's roped in there over the course of the past 9 years. Of course, you can also find it in all of your favorite platforms, iTunes, TuneIn, Stitcher, et cetera, even via our mobile app, which is also available on all of the major app stores. So check it out, the Options Insider Radio Network mobile app, wherever you find your favorite apps on whatever device you happen to be rocking on your person. We don't judge. As long as you're listening, downloading, streaming, we don't care how you access it. And I am joined, as always, by my usual volatility compatriot / partner in crime, the Greasy Meatball himself, Mr. Mark Sebastian from OptionPit.com. Mr. Greasy Meatball, welcome back to Volatility Views, and Happy New Year to you, sir.
Happy New Year. It's great to be here. Great to be alive. Quite the week. I don't know if you saw this, but on Tuesday we were up 4 points.
Yes, how could I possibly have missed that? It's been quite a boring week, actually, you know.
It's super boring. If you just look at Tuesday, it was really boring this week.
You know, it's funny. On our last episode, we were all collectively, myself, you, and Russell, we're all kind of collectively lamenting now that the Fed was done. It looked like the end of December and certainly the first part of January. So the better part of the next trading month was going to be pretty boring. We maybe had earnings on the horizon in mid-January, and that might be the first thing we could really look forward to really anticipate some vol, a little bit of spark of life in the markets. But before then, it really seemed like it was going to be a boring month or so in the old market. Most of us were predicting sell-off. The VIX Cash was around the 20 handle at the time. I was thinking you're in the 18 handle. You were thinking pretty dire. You were thinking 16 handle. I think Russell was somewhere in that 20 handle range. He wanted to keep things even. None of us predicted what was to come, which was roaring out of the gate with a lot of crazy stuff. We'll get to all of that in a minute, listeners. But first, let me introduce my other cohort here. He's been on the program before. We are, of course, our friend Russell Rhodes is on yet another plane. The guy is quite the traveler these days, so he won't be able to join us today. But we have a very able stand-in. He of VIX Mullet fame, Mike Thompson, the co-founder and investment officer over there at Typhon Capital Management. Mike, welcome back to the program, and Happy New Year to you as well.
Yeah, Happy New Year. Thanks for having me on. Appreciate it.
Yeah, a lot of fun stuff to talk about, rather. So without further ado, let's keep on rolling into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review, our first Vol Review of 2016. So we thought, what better opportunity first before we get into all the madness and the maelstrom that is swirling in the markets right now. We thought we'd take a moment to look back on the year that was 2015. It was an interesting one from a variety of perspectives. It seemed like a lot of different narratives were playing out over the course of the year. One of them was, aside from a few strong moments of vol out there, in terms of volume, the VIX options at least weren't lighting it up overall. VIX Futures did pretty well last year. We'll get to all that stuff in a minute. Of course, overall, it was a pretty weak year for options as a whole in 2015, with the industry having one of its few down years from year over year from 2014. Of course, 2014 being a very robust year from an options volume perspective. So you look at that from last year from an overall options perspective, the options world was down about 3% in volume in 2015. So they're already kind of setting a lower bar there by itself. Of course, if you start parsing out some of the things that are more relevant to this audience, like index volume, a little bit better game to be in, only down about 1% in 2015. That's, of course, across the broad array of products, so SPX and SPY, et cetera, all of the products out there. And speaking of SPX, it did a lot of numbers last year, setting a lot of records, total annual volume and ADV reaching all-time highs. So despite the fact that overall volume off, SPX really lighting it up, 236.5 million contracts for the year and about 940 contracts annual ADV. That's a ton for such a robust and sizable contract as the SPX. Like I said, VIX options not setting an annual volume record, which I think doesn't surprise anyone who's listening to this show over the past year, because there were a lot of days where the product just wasn't really hitting its ADV there. Of course, there were those exceptions, those days when our friend the 1x2 whale would come in and others that would really knock it out of the park, and there'd be over 1 million days. And of course, that heady period of late August into early September where everything was rocking and rolling, everything was printing a lot of size and a lot of volume, VIX included. So VIX options and not setting overall records, but VIX futures, surprise, surprise, once again knocking it out of the park this year, setting new total volume and average daily volume records for the 6th straight year. Again, growing from a smaller base, so that kind of helps, but still just a strong year from the VIX futures perspective. 51.6 million VIX futures total volume for the past year. That's up 2% from 2014. And the ADV out there, about 205,000 contracts, also up 2% from 2014. And in that first year of 24-hour trading, or just about close to 24-hour trading, they also did about 4.5 million or so contracts in that after hours period. That works out to about ADV, about 18,000 contracts in those extra hours. So the people overseas getting a chance to play a little bit more in their time zone, friendly times as well. Since we're talking VIX futures, it's a perfect opportunity to welcome on Mike here of VIX Mullet fame. He plays mostly in VIX futures, as you might remember. Mike, a good year to be active out there in VIX futures, at least from an overall volume perspective. You knew you had some liquidity you could play with, even though, as you said on the show last year, sometimes the term structure wasn't shaping up the way you would like. But that said, looking back at 2015 from a VIX futures perspective, what really were some of your key takeaways from last year?
Yes, I think last year can kind of be thought of pre the August flash crack, as we're calling it, and post the August flash crack. Two completely different environments. So it's basically like 2 years in one. Certainly easy to be active last year. Far more difficult to be profitable last year. Trading vol. There's a lot of opportunity to whipsaw yourself and be in positions that didn't work out. So certainly dancing through the raindrops was what you needed to do in 2015, especially in the back half of the year. So I think it was, an interesting time. We feel the market has really shifted post that August flash crack. I think Sebastian has talked about this before, that, maybe 15, 16 is kind of the new 12, 13 in terms of spot VIX floor. We've seen a ratcheting up of the, kind of the lower levels for VIX. And in fact, we were looking at it today. One of those rare occurrences. Since October 20th, you could just buy and hold the front month VIX future and have been profitable since then, with almost no, underwater from your cost on October 20th. And that's certainly a change from, the normal kind of contango environment.
Well, you guys always like to come on with your nice little ways to describe the VIX setups out there. You, of course, had the VIX mullet set up. You had the kick the can trade. Now you have the flash crack. I like that. And it really is appropriate for what we were talking about. Listeners can just go check out your appearances on the show throughout the year last year, and in the early part of the year, you were kind of lamenting the lack of really anything for you guys to do out there. The term structure wasn't lining up the way you needed it to. So we were talking on some of your earlier appearances about you guys looking farther afield beyond VIX Futures, some of the other products, commodities, Russell, et cetera, to try to find those shapes, those setups that you need. And you're right, once that August flash crack, I like that, took off, it was a different market from then on. We had a different term structure. We had things going crazy. The front end of the curve was going crazy, of course, but also the back end of the curve was a little bit more active and crazy and bizarre and steep than you might expect to see at that time of year, and things were rocking and rolling. So certainly a lot of setup. So you're right. Maybe if there is one kind of takeaway from last year is that we had a bit of a bifurcated market, the pre-flash crack, flash crash, minute drop, call it what you will, and then post where we really had a lot of activity. And then, of course, the Fed helped keep that alive for the end of Q3 into Q4 with their continuously punting on will they, won't they raise. And that, of course, injected a little bit of structural volatility in the marketplace, enough to let the market come into the end of the year with at least a little bit of vol to look at. And I think you're right. Mark's been beating that drum on the show for a while about the new floor of 16 out there in the VIX land. And given where we are today, VIX Cash hovering on the mid-20s, I don't think anyone's going to argue with that. Mr. Greasy Meatball, will turn our attention now to you. That, of course, was one of your takeaways of last year, a higher level of general structural volatility. But that aside, what else really caught your eye in the year that was 2015?
Well, all right. So let's correct what I said about last year. I said that I thought the beginning of January could be ugly, and that prior to then we could break 16. And if you look, the VIX actually did break 16. And I think it may have actually been on our last show when we were talking about this. And I said, if you think volatility is about to increase, then premium is at a complete discount and should be purchased. Do you remember, it was an interesting discussion. And, the market proved it to be true. We've got a massive push in realized volatility. I think, if anything, I think people are surprised by has been the lack of push of a much bigger push higher in VIX, despite 3 days with, 2% moves plus. This week, we've got the VIX sitting around 24. We've got the whole curve backward, but we've not seen any real panic out of the market. I would say that it's been somewhat orderly, and perhaps it's due to some of the hedging that we saw in the week prior to all this. Recall there was lots and lots of VIX upside call buying from a few customers in the week in between Christmas and New Year's Eve. And buyers of the 26, 27s, 28s, 30s, all the way up to the 35s. And so, I likened what we're seeing to the difference between August was kind of taking a gut punch when you're blindsided and you don't see it coming. And this is more similar to taking gut punch when you absolutely know it's coming. Someone can hit you just as hard, but it doesn't hurt as much. And you're far more ready to withstand the pain. Now, that being said, I think, Mike, I'll throw this back to you. Why don't you give the audience a little history of S&P performance when the curve goes backward out 3 and 4 months?
Yeah, I mean, when the curve goes backward out 3 and 4 months, it is generally you want to see like a real vol dust up. Then you have some positive performance numbers for the S&P. But when it's in this middling stage, let's call it between 20 and 26 on VIX with a backward curve, your forward 30-day expectancy is negative for the S&P. So we're kind of in that zone where historically speaking, the S&P struggles. And I think Mark and I have been talking about, maybe the analogy is kind of the 2001 type of market where outside of the September 11th attacks, nothing spectacular happened. It was just an exhausting grind down in equities. So I think you're kind of in that environment.
Yeah, we certainly are. It is kind of interesting, and you're right, Mark. I did perhaps mischaracterize your statements there. I was right on the 16 end. All the stuff around it got lost in the resulting maelstrom of the last couple of weeks, and what a maelstrom it has been. Before we get into that, really quickly, Russell couldn't be here, but he wrote a great piece over there on the SKEW Options Hub. You guys should check it out if you haven't already. It's called, let me get the full, 5 Volatility Market Takeaways from 2015. So I'll give him a chance to expand upon this and expound upon it when he's back next week. I'll just do a quick rundown for you guys right here, listeners. Number 5, he pointed out the long and short volatility ETP performance. In particular, a lot of these inverse things like VXX and others said the great lesson is how these inverse funds don't really return what you think in terms of giving the opposite of their long fund counterparts. His number 4 point was that backwardation alive and well in 2015. About 20% of the days, 1 in 5 last year, the front month was at a premium relative to month 2 in terms of the futures out there. Number 3 takeaway was that the SKEW was still pretty robust out there in 2015. In 2014, the SKEW averaged about 129.75. That's, of course, coming from the CBOE SKEW Index. And a lot of people, including Russell, kind of thought that was a bit of an aberration. Then last year, it averaged about 127.5, so pretty close to that, despite the fact that VIX was actually a bit higher level out there in 2014. Than 2014. So that's his number 3 point. Number 2, we got something we talked about in the show a number of times throughout the year. The vol out there in the Russell was surprisingly and indeed relatively compared to SPX pretty low. There was even that one much talked about point where Russell dipped below, the RVX dipped below the VIX, which is, structurally probably shouldn't be the case. Structurally, small caps should be, just by their definition, more volatile than large caps, and yet we saw Russell actually break that relationship very briefly last year, and in general, just be a lot lower than I think a lot of people thought. It averaged for the year was 19.39 out there in RVX. That's actually down a bit from 2014's average of about 19.42, despite the fact that we saw some interesting developments from a vol perspective in the end of 2015, still lower than 2014 from an overall vol perspective. And his number 1 takeaway was that the VIX average was actually closer to historical norms. He got some great charts in here. I'll let you guys go and check them out for yourself. But essentially, he kind of wanted to reiterate the point that the VIX was closer, pretty steady to that 20 level that SKEW puts out there quite a bit as the long-term average of VIX. We've had a lot of discussion about that on this show over the past year, so I won't continue that, but I'll give Russell, when he's on next week, a chance to expand upon all of this as we roll on into what we've been seeing this week. As Mark and Mike alluded to, it has been kind of a crazy week out of the gate. We are recording this, of course, on Friday, January 8th, for all of you playing the home game out there, and we were kind of jokingly referring to Marcus I, referred to on our last episode about how it didn't really seem like there was a lot of potential for a lot to really cook off in the beginning of the year. Certainly no one expected the market to come roaring out of the gate the way it has so far in this first week of 2016. I've lost track now of how many different headlines I've seen somehow comparing this week to the catastrophe of 2008. That seems ridiculously overboard in my sense, but still it's out there. I think it's because George Soros may have mentioned it somewhere and the media kind of took off and ran with it. Everywhere we're seeing now is this 2008 writ large. I think that's kind of absurd on the face of it. We don't have our entire financial system becoming essentially insolvent overnight like we did back in 2008 and the Fed scrambling to the rescue. That said, there are a lot of things of concern, most of them in the macro sense. Of course, we came out of the gate with the first Chinese meltdown, call it what you will. That was followed, of course, by, the escalation of tensions out there in Saudi Arabia and Iran. If that wasn't enough, we were followed shortly thereafter by the threat of an H-bomb coming out of North Korea. That's usually enough to rattle the markets in and of itself. Then on top of that, we had Chinese meltdown number 2 on Thursday, and all of that combining for a terrifying start to the new year. As we alluded to there at the top of the show, VIX Cash has been at, shall we say, elevated levels of late, even though perhaps not as much as you might think given everything that's been cooking off out there. We saw the VIX Cash reach a high of about almost 26, I believe, yesterday. Settling in right now around about the 24 handle right now, still well above a lot of the levels that anyone anticipated. And Mike, I think we'll start with you as our guest. These are obviously some rocking and rolling, turbulent waters to start the year. You guys actually tend to like this kind of stuff. It gives you some interesting opportunities perhaps to come in and set up from a VIX Futures perspective. So walk us through what you're seeing out there right now and what's catching your eye in this extremely turbulent start to 2016.
Yeah, I think first thing that's catching our eye is, like we've all mentioned here, is sort of the underperformance of what we thought the VIX might do on a rough S&P start to the year. That being said, VIX is running well over 10-day realized now. So VIX has outperformed realized vol on a 10-day basis. So for us, the setup is we're looking at owning volatility where we can here, given the curve structure. The high VVIX, I think causes some problems with trades like that, because you have had an environment, basically since the Fed's been involved in the market, where VIX can spike, but have an equal or greater spike on the way back down, as you've had, previous kind of V-shaped recoveries. So I think we're kind of fighting through that old playbook, transitioning into a new playbook for equity market participants. So I don't think that slam back down in vol playbook is as valid anymore. So, we're kind of leaning towards the long side of volatility, especially with the curve a little bit backward, but trying to be, sort of as measured as possible when putting on those positions. Our technical term for the vol environment right now is a Lindsay Lohan. It's a kind of a hot mess.
It's a Lindsay. I like that.
That's good. A hot mess. I like that. Did you come up with that on the fly, or is that an official Typhon term?
That's official Typhon term. No, we were laughing about it earlier, trying to stick with our previous, iterations of cool code words. So that's not a strategy.
We got a Lohan.
Yeah, we got a Lohan.
You got a shaved, or you could call it a shaved Britney.
We've called it a crazy Ivan before, so there's all sorts of terms. But yeah, I think that old playbook, sort of pre-August 2015, where any vol spikes were crushed back down pretty quickly. You had kind of equal dramatic moves on vol on the downside as you did on the upside. I think the eye-popping moves will be to the upside, and if vol does cool off, it'll be a little more traditional, where vol kind of bleeds back off instead of crashes back down. I think, you see those high SKEW numbers stick even after markets rally back, like in October and that kind of thing. I just think that whoever was buying options or protection that drove those SKEW numbers higher, whatever transpired, August through now, is not the event that the hedgers were looking for to cash in that protection.
So you're seeing more of a sticky vol environment where we pop up and then kind of come back down. slowly. Kind of like oil prices sometimes at the gas pump, at least, or gas prices, I should say, more than oil. Oil's been moving around quite a bit as well. We'll get to that in a little bit. I like that Lindsay Lohan hot mess. You guys are always good, if nothing else, than for a few good terms in there. I would allocate some capital to you for you guys, if for no other reason than just the names of your strategies. That's worth it for me, for a nice chuckle whenever I check my portfolio every quarter. I like that. You mentioned too the prices of those puts and kind of the structural vol. You guys obviously play in the futures, so you're looking at the farther end of the VIX Futures curve. We've seen a lot of debate of late, and we haven't had you on the show since we've kind of started talking about this. We've seen a lot of debate out there. It's been bandied about in a few different outlets. What's driving the cost of some of those puts up? Is it really the fewer liquidity providers in the marketplace right now? Is it also perhaps as a result of some of these increasingly severe stress tests that the banks are being forced to undergo? Therefore, they kind of have to own these things. We see a similar kind of scenario playing out there in the longer term of the VIX futures term structures. Similar players play in both spectrums. And so I'm curious for you what you think the reason is in terms of maybe not so much the S&P puts, because that's not really where you guys play, but in terms of keeping those farther end of the VIX futures really elevated and steep. Do you think that is a result of perhaps fewer players out there? Is a result of these stress tests or something else entirely? What do you think is really helping to contribute to that?
Yeah, I think, with most stuff investment related, it's a combination of variables. I think the lack of ability for banks to, kind of make markets that's technically defined as prop trading has certainly driven different market participants to come in and make markets. The pickup in VIX futures, a lot of the volume is in the first 2 months, and generally those market makers have to lay off with back months, essentially do spreads along the curve. So if you have a lot of front end demand, the dealer's going to be short the front, and they're going to have to be buying ratios in the back. So you can have some market structure demand there just from market making activities. And I think in general, it's a symptom of, I think we talked about this previously, it's a symptom of the market knows there's a problem. It's having a tough time placing the date of that problem when it will kind of explode onto the scene. So you're seeing a lot of bets be spread further out in time.
Yeah, it's interesting stuff. A lot of the same players, of course, playing in both ends of those products there. So it's kind of interesting to see your thoughts on that. Mark, you kind of already give us a little bit of your overview, but obviously a lot is really popping off this week from a vol perspective. Give us kind of your thoughts here as we're putting it in. First off, hopefully you can join me in debunking this it's not 2008 thing that people are somehow grabbing onto, that it is the same thing as 2008. So hopefully you have a similar viewpoint to me. You're not in that hysterical/histrionic camp. And then secondly, what else is catching your eye out there?
I think Soros was talking up his own book, if you wanted to know my opinion.
You're lying, sir. I refuse to believe you.
The old saying, my outlook is my position. And, when I look at the market, and I was having a conversation with a couple of people at this, it feels a lot more like coming off and Matt and I, or Mike and I were actually talking about this. I'm calling it kind of the China.com bust, in that, if you remember, we had kind of in 2000, after we had the big .com bust, we had a kind of a big wash. But then after that, really the market was just kind of slow, molassesly ugly from kind of the middle of 2000 to kind of the beginning middle of 2001. The market was down a lot, but in a malaise way, not in a VIX going to 87 in a trade, not in a panicky type of way. And the way we're selling off and the way the market is trading around this, I get kind of the same feeling from it, that there's kind of this malaise setup. Now, that being said, I'm watching the S&P really closely because we opened up this morning up nicely. I mean, futures were up over 25. I want to say Dow futures were up over 200. S&P futures were well over 20. The market opened up in cash, over 100 in the Dow and over 15 in the futures. And Now we've got the Dow down on the day, and we've got the SPX down on the day. We've got the RVX now up on the day with the Russell down. The only thing holding up the NASDAQ is that, if there was any panic anywhere in the stock market, was every Apple investor simultaneously crapping themselves. And so we're seeing a little bit of a recovery of that today, and that's holding up the NASDAQ. But I think that there's potential maybe Monday for, especially if China's really bad over the weekend, for something ugly. And then, but, I'm kind of in the, Mike and I were talking more about this. I'm kind of in the we rally kind of back half of next week pretty hard when all is said and done. Other things I'm watching, there's some gold vol trading and some silver vol trading. Oil's gotten so cheap that, the vol really can't go much higher, which is kind of an interesting thing to watch. And that's part of the reason why we've not seen the OIV just completely explode. So, that's kind of where I am and what I'm seeing. If there's strength, it's in airlines and kind of Apple and Facebook. So that's kind of what I'm viewing right now.
Yeah, it may surprise some people to hear you say, of malaise, given how just crazy it's been over this week. But, it actually is borne out in some of the numbers. If you look at what we were seeing earlier this week out of the gate, I mean, it was a surprising move out of China. The markets were panicking, yet we didn't see as robust of a reaction from the volatility products as you might assume. VIX options have been averaging around 500 some odd thousand contracts a day, only doing about 431 out of the gate on Monday. So sub ADV, even given everything that was going on out of China. And then you add on the Saudi Arabia news and everything else going on Tuesday, and still only about 367,000 contracts on Tuesday. It took the threat of the H-bomb to finally break the ADV, and still sub 700, about 691,000 contracts on Wednesday. It wasn't until China Part 2 where we really saw some really appreciable, sizable volume out there, about 922,000 contracts out there in VIX options land. So you're right, it was kind of a bit of a slow start, despite the fact that things were rocking and rolling on the underlying and on the net vol side. The products themselves weren't perhaps reflecting that. Perhaps some of that also reflecting the fact that people weren't maybe ready for the markets to kick off that fast. People still coming back from their long, protracted holidays and things, and just kind of getting settled, hoping for perhaps a quieter start to the new year. They weren't ready to pop off 1 million contracts in VIX on the first day out of the gate. And today, so far, looking like a pretty robust day. We are recording this about middle of the session, and about 410,000 contracts going up in the good old VIX options, even though, as Mark said, we are kind of hovering around the unch level, giving up a lot of those earlier rallies we saw out there in the broad indices. This is usually part of the show where I would toss to Russell for his weekly option rundown. He isn't here, so I will do it myself. I was going to put together a nice little jingle for him too, Mark. Maybe we'll have it on a future episode. But the VIX weeklies have been lighting it up of late. And if there was a bit of a narrative this week, as Mark mentioned, going into the holidays, there was a narrative of people just gobbling up tons of upside out there in VIX, which could be part of the blame for this kind of muted response. We've seen people already have their hedges in their back pocket, so they don't need to scramble on the first day of the Chinese meltdown because they got it already back in mid to late December. But we did see a bit of a flipping of that script this week, maybe kind of going back to your point earlier, Mike, about the VIX downside moves. People wagering pretty heavily on some VIX downside to the term. We don't really talk about VIX puts a lot. VIX puts were lighting it up, certainly compared to other recent weeks out there this week. Wednesday seemed to be a pretty active day in particular. The Jan 16 puts expiring on the 20th going up. Someone gobbled up a bunch of those little teeny things for about a dime. That was on Wednesday. Thursday, we saw paper buying a ton. Looks like they were buying, looks like a bit of a stupid, actually. The Jan 18 and 17 puts also going out around that same time frame on the 20th for about 46,000 times each on both of those. So people just gobbling up puts here on the downside. People perhaps trying to put the lie there, Mike, to your notion that we're going to have the slow kind of lingering drawdowns in VIX. People perhaps coming in the other side and saying, you know what, they're specking. Maybe they're looking at more recent history, thinking we're going to reflect that again. It's going to be a sharp decline. But either way, Mike, it seems like some paper is taking the other side of your bet there. We're going to have a sharp move to the downside.
Yeah, I think that's that's kind of the 2013 through middle of 2015 playbook being implemented still. We don't see those slam downs happening, outside of some sort of reversal in course from the Fed to come in and basically be the Fed being a huge implicit volatility seller. We just think it's going to be a far more two-way market in volatility this year. So, I think those types of trades are from an old playbook, if you will. And I think vol hasn't really, exploded to the upside because we haven't seen any bodies float to the surface yet, so to speak, with all these things that the market's worried about. There hasn't been a Chinese bank in distress. The closest thing we've seen is Glencore, and then most recently Noble, the big commodity houses, be under some pressure. But we haven't seen anything like a Bear or a Lehman, or even rumors of that kind of stuff. So until you see a body float to the surface, volatility is not going to hit the escape velocity, if you will.
Yeah, you're right. For all of the play that hedge fund got out of Shanghai, it was only like a $46 million hedge fund that was liquidating. That may sound like a lot, but in the grand scheme of hedge funds, it's pretty much a drop in the bucket. It certainly isn't a Bear or a Lehman. So you're right. We haven't really seen that. Again, puts the lie to this narrative that we are somehow living through a retread of 2008. Things may be a little bit scary in the near term, but it's certainly not anywhere near the scale of the Great Recession / depression, depending on how you view it there, that we were lingering on the brink of there back in 2008. Yeah, puts seemingly the order of the day. Calls, of course, still lighting it up out there as well, but just comparatively volume-wise, puts doing some pretty decent numbers out there on today. Actually, this morning looks like the Feb weekly expiring on the 3rd. 16 puts also lighting it up. Paper buying about 13,000 of those, as well as looks like some of the Jan expiring on the 27th weekly 16 puts as well, gobbling those up. So puts kind of the order of the day, or at least compared to normal. That's where more puts than we typically see out there in good old VIX land. The open interest is still hovering at relatively normal levels. Calls over puts about 2.5 to 1. You guys listening to the show for a while, these things can get pretty wonky out there. It can get up over 4 to 1 sometimes with the call time. So the fact that it's only hovering around 2.5 to 1 again shows you that there has been some put love. Looking at over here at the hot VIX strikes going up right now, we do see some puts over there. There are 2 put strikes actually in the top 10, which is an unusual occurrence for us. The number 1 through 7s all still lighting it up on the call side, starting again here with the Jan 30 calls, 350,000 of those bad boys open. So that's far and away the number 1 hot strike. Coming in, the number 2 is the Jan 22s with about 209,000, and the Jan 28s 195,000. Number 4 falling off a bit there are the Jan 29s with only 155,000 open. Again, we're kind of in the rebuilding phase here from an open interest perspective. Number 5, the Jan 25s, 151,000. Number 6, Jan 27s with 148,000, followed by the Feb 35s. Got to go all the way down to number 7 to find some Feb. Feb 35s, 132,000. Then we get to number 8 with the Jan 16 puts, that much ballyhoo Jan 16 put I was talking about. 126,000 open there. That 16 put strike seems to be popular across the board, followed by the Jan 17 puts, 121,000. And then rounding out the top 10 here, we have the Jan 35 calls, the ever optimistic Jan 35s with a paltry 117,000 open. All of that combining for a relatively slight sub 5 million open interest, about 3.5 million in the calls, about 1.4 or so in the puts. Before we wrap up the vol review, Mark, you mentioned crude. Crude has been rocking and rolling of late. Again, a lot of that to the downside. We've talked on some of our recent shows about how that vol premium, that put premium existed pretty far out in the futures and futures options term structure in crude. In fact, on our last show, we were talking about how that extended pretty much out all the way into Dece of 2016, so the end of this year. Of course, we've seen some aggressive down moves since that, some of that premium having come off. Like Mark said, we're kind of at that point now, or how much more can it move in terms of volatility out there, and also perhaps to a degree in terms of underlying too, to the downside at least. So it's been an interesting time out there. Mark, anything really catching your eye out there from a crude volatility perspective this week?
Yeah, I mean, it's moving around. They continue to slap it. You know, they keep just hitting it. You know, they're hitting crude, and the vol is just not hitting new highs, and that's because how much lower can crude go? It does have kind of like a lower bound at some point, you know? And I think that's maybe what we're getting near.
Seems like we've been saying that for the better part of a year now.
I know.
It continues to confound people. You know, that was the really big rallying cry, I believe, towards the early part of last year when it really got around the 60 handle. It seemed like that was the big time everyone was really wagering on that bounce. We saw that reflected out there in the WTI and the Brent SKEW in terms of people really loading up on crude calls. We also saw a ton of futures going up, a lot of bullish positions, and we all know how that worked out. Not too well. A lot of those guys got burned. So we've seen, probably not surprisingly, a bit of a reluctance to load up on the upside yet again. It does seem like now that we're down, hovering, vacillating in the mid-30s to low 40s range, people are getting a little bit more comfortable with getting a little bit of upside. Still not call heavy by any means out there in the SKEW, but they'll buy a call or two now. Just to have maybe in their back pockets against this. Because at the end of the day, 35, how attractive is that, 30 or 25 handle put at this point? Probably not very. Of course, we have been saying that for a while. Mike, before we wrap up on crude, I know you guys are mostly watching the VIX Futures, but you keep an eye on other products out there. Anything catching your eye, maybe setups or term structure-wise in the big crude futures or the big crude volatility that's catching your eye lately?
Yeah, we mentioned before, crude matters to us because it flows through the high yield market, which has high correlation to the VIX market and the futures that we trade. So we're always keeping an eye on it. Part of our what we call the gray box indicators. But just listen to you guys. I would be interested in putting up like a crude vol versus that solar ETF vol, and look for some kind of pair trade there. Because if crude keeps going down, that thing will get smoked. Just drives the economics completely out of renewables and that kind of thing. So I'd be interested in looking at, playing those vols against each other.
I like it. Solar versus crude pairs trade. Perhaps what's the code name for that over there in the Typhon offices? Is it perhaps the I don't know.
I'd have to think of something that's like like old school versus new school energy trade. So whoever would represent those, I'd have to think of names for that.
Fossil versus flex, something like that. I don't know.
Yeah, right.
That's the best I can do off the top of my head, listeners. Give me some time, and we'll get something
like
better.
T Boone Pickens versus Elon Musk.
Yeah, Texas T versus Tesla, something like that.
Right.
I like it though. I like it. Well, good stuff. We'll have to put it up there near the Lindsay Lohan / mullet category. All right, listeners, that's going to do it for the vol review for this week, and now we'll keep on rolling into the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options. or facebook.com/theoptionsinsider.
All right, everybody, welcome to the Volatility Voicemail, our first little mailbag here of 2016. This is, of course, a portion of the show where you guys get to join us with your questions, your comments, your insights, your analysis, not just for us, but for your fellow Vol Views listeners. Going to kick things off with TCruz. He writes, will we ever see a daily VIX option? We are, of course, without our registered SIBO representative, so we'll have to struggle on answering this one ourselves. And I've kind of said this before on this kind of ever-present narrative, it seems like, in the options world towards short duration. I mean, the success of the weeklies has not gone unnoticed. These are pretty much, if you could name one broad success type category of product over the past few years. Weeklies are they're kind of where all of the action is these days. I mean, how many times have we talked just in the last few months on the show about how much volume is going up in VIX weeklies, and they're a relatively new addition to the ecosystem. So it's not lost on anybody in the business that short duration is where the action is. I think where the hesitancy has come from a lot of people that I've talked to in the space who would launch something like this is that there's this long-standing reticence in the world of options to prevent any sort of connotation of gambling with the product. You know, options/derivatives have a pretty bad track record in terms of broad public perception. People still link them to headline-making disasters like Barings and Orange County, et cetera, even though it wasn't really the fault of the product there. It was the use case. But still, those kind of things linger in the mind of the public. And this is an industry that until a few years ago wouldn't even have a conference in Las Vegas just to avoid that perception altogether. So it's still alive and well. I think it is going away. And at the end of the day, I think money talks and people are seeing short duration. So I think it's only a matter of time within the next couple of years, maybe even shorter, maybe in the next year or so. We'll see. I think one of the smaller exchanges, I don't think it'll be SIBO, so I don't think it'll be VIX right away. I think we'll see one of the smaller exchanges with less market share that has nothing really to lose from an experiment try a short duration daily type product. We're already seeing binaries out there from firms like Nadex that are doing fairly well. So I think it's only a matter of time until someone tries it, and then we'll see how it resonates. When SIBO will do it, I think it'll probably be a little while. They like to let things kind of play out in the marketplace, I think, before they would jump into that. That said, maybe, Mark, what are your thoughts here for TCruz? Do you think we'll see a daily VIX product anytime soon?
Now, is T short for Ted? Am I
You're right. I didn't even think about that. Maybe he's right into our
presidential candidate? Is that what's going on here?
He's spending some time slinging some weekly VIX options, hoping for dailies.
Yeah, no. So here's the problem with a daily VIX option is that it's a total crapshoot. I can't think of a single market maker that would want to make markets in something like that. So the closest thing you've got is those binaries that they do trade. And if you were going to do a daily, you would need it to be some sort of binary trade. I don't know anybody that would take the kind of, massive upside and downside risk associated with a short vol, basically daily short vol positions. I just don't see it. And thus, that is not a product that I envision actually ever being built. We'll see daily options on stocks, maybe, but I don't think we'll ever see that on VIX itself.
No, you're right. You can't really downplay the market maker portion of that enough. I think everyone was convinced that the mini options were going to be a home run, and then surprise, surprise, the market makers really wouldn't touch them with a 10-foot pole, and that, amongst a number of other things, really contributed to the early demise of those products. So if they wouldn't touch those, you're probably right. They would be a little bit reticent to sling size on a daily VIX. I'm guessing the paper flow there would probably be kind of one way, but you never know. But I'd probably go out on a limb and say that. So it'd be kind of hard to really effectively make markets in that on an ongoing basis. That said, people said the same thing about VIX when it was launched. Who's going to want to be the one guy providing the layoff product for the rest of the SPX crowd from a vol perspective? And look how well that one turned out. So things do surprise us sometimes. But you're right. The market maker spectrum and the fact that they've been so decimated, really they are reluctant to pick up anything new these days, and that could certainly be an issue for that. Let's see. I think we got time for about one more here. Let's go over this other one here from Vin L, or perhaps Vinyl. Perhaps he's another one with a clever username here. He's like, hey, love Options Insider Radio. Well, thank you, Mr. Vinyl. Been mainlining Volatility Views. Well, you're a man of exceedingly good taste, we could tell. He goes on to write, you always talk about the lack of VIX put volume on that show. Well, let me just pause for a second. Not today. We talked about a ton of VIX puts in the top 10 and going up this week. So today is the one aberration. Anyway, he finishes up here. Is there a particular month that is most attractive for VIX put buyers? And that's an interesting one. I think people might instantly assume it'd be something in the summertime because that's traditionally associated with a generally lower level of volatility overall. But remember, that's kind of a general malaise period with kind of a slow, kind of the opposite of what Mike was talking about earlier, where you have these sharp drops. That's kind of more of a slow, lingering malaise. That really is not an attractive time to be owning any downside out there. So it's kind of an interesting structural question. Mike, you look at the term structure out there quite a bit. You're pretty active in the VIX Futures. So looking at that, does anything jump out at you as a month that is particularly attractive for, in the case of vinyl, to be buying puts, or perhaps in your case, to be out there shorting some futures?
Yeah, there is a seasonal bias, except for the past couple years, where December futures generally traded with a small dent in the curve in December. And I would definitely echo that kind of late June, beginning of July, historical seasonal patterns. Vol does tend to kind of bottom around there, around the 4th of July. That being said, if you and I are talking about it, the market makers know about it, and it's going to be priced as such, with those seasonal biases in there. So a seasonal pattern is not necessarily going to give you a whole bunch of edge.
Yeah, you're right. And it's usually not a sharp drop down to those July 4th bottoms either. It's kind of a long, slow dance, which never is attractive. From a put buyer perspective, you can do it with a short future. Not as attractive either than a sharp move, but still it'll work out for you. But you're right. That's kind of it. Mark, anything you want to add here for our friend VinL or Vinyl?
No, I think Mike pretty much showed it up. If you're, all of the things that are known by everybody. That's one of the few things in terms of efficient markets I actually do believe in. So if you and I know about seasonality, so does everybody else, and that's going to take out some of the real edge in it. And you actually see that in the way things trade. The 4th of July, they start taking volatility down on June 15th, not on July 3rd. And so, if one's willing to put a leg out and really try and time things, maybe one can't profit, but it's not the layup that a lot of retail investors think it is.
Speaking of surprising seasonality, we're coming up on February. That's always the month I've said in previous years. It's kind of when some of the crazies come out from a VIX options perspective. People loading up on crazy optimistic nonsense like Feb 75s and others. So I'm waiting for a few of those. Talking about surprise seasonality, maybe we'll get a few of those in our back pocket. Looking today, 4,000 Feb 47.5s did go up today, so maybe something interesting. Maybe the crazies are starting to come out, but if you want some surprise seasonality, maybe February is it. Not on the put side, but more on the crazy call side. Not to say that it really works, but you might see some paper flow out there at least. So that's something to watch. That's about all the time we have for the Vol voicemail. Now we'll keep on rolling into our final segment, the Crystal Ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the Crystal Ball.
All right, listeners, this is, of course, the portion of the show where we all go out on a limb and usually embarrass ourselves thoroughly. As I said last episode, we were kind of all over the board, but most of us pretty much south of 20. And I think Russell was the highest. He was maintaining that 20 level. And we weren't predicting all the way this far, so I'll give us that caveat. We were talking about the subsequent week, and that indeed did bear out in the subsequent week. But, of course, now we're off to the races again, and it's an interesting time. Mike, I'll give you the somewhat dubious honor of going first, since you are indeed our guest. Looking at everything cooking off this week, it's kind of a bit of a crazy time. We're hovering still fairly elevated levels here in the VIX Cash, right around the 24 handle still towards the end of this show, even though it is coming off a little bit right now. What's your model telling you? What's your Lindsay Lohan / mullet / kick the can model looking at and telling you for the week to come, this time next week, from a VIX spot perspective?
Sure. In the Lindsay Lohan hot mess environment, position sizes are kind of minimum size. These types of environments are not the appropriate ones to take a big swing at any one signal. That being said, 2015 did have a pretty consistent pattern to it that the week of options expiry for the indices had a strong upward bias. And I think coming off, a pretty rough or very rough, historically rough week this week, I think the expiration bias is up. You have a whole slew of bank earnings next week, and that tends to be a volatility suck out of the market. To me, that would be, kind of a counter trend move. If the S&P did rally and vol, cooled off to, let's say, 19 to 20 maybe. I could see that happening in the short term. But I do think that the issues that are bothering the market are not kind of binary in nature, where they're solvable by a decision of Congress or whatever's bothered the market in the past. So I think vol is still fairly well bid because we're sort of moving through bigger macro problems. The China question mark is not going to be solved in a week. So I think next week, vol is going to come down. S&P is going to rally a bit, just more of a technical bounce. And then, after that, everything is sort of dependent on if there are any bodies that float to the surface from, the Chinese problem, or if there is geopolitical actual shooting between Saudi and Iran, that would definitely get vol moving.
All right, so slightly lower, but nothing too crazy, you're thinking?
Yeah, short-term counter-trend rally in S&P and the corresponding, vol slight cool-off.
Yeah. And Mr. Greasy Meatball, your thoughts on this time next week, sir?
This time next week, I am with Mike. I think that, especially if things get real soft into the close today, I think there's potential for an ugly Monday followed by some sort of recovery, with the VIX being, plus or minus $2 from where we are right now. I don't see a ton of reasons for a wicked recovery here. The market is, the market's sick, is the way to think about it. It's not, it's not like the market's being shot at with a bazooka. The market has a really bad case of strep throat right now, and that's the way it's trading.
I think we're all pretty much in agreement. So that's no fun to have me come in and be the third voice echoing that sentiment. So I'm going to play the crazy contrarian and say it's going to pop off next week to some crazy degree. We're going to be at 30 handle next week. How's that for crazy? So that'll set us up 2 relatively level-headed guesstimates and then one crazy contrarian upside pick. So there you go, listeners. Have at it. We'll see how it plays out next week. Unfortunately, that's all the time we have for the crystal ball for this episode of Volatility Views. It's also all the time we have for this episode of Volatility Views. But before we go, as always, let me check back in with my cohorts here, my volatility partners in crime, see what they have cooking that may interest you, starting with our guest co-host here, Mike. You're always working on cool, interesting new strategies out there. You got the Lindsay Lohan, you got the mullet, you got kicking the can, all the other fun stuff. What else is coming down the pike, and what can our listeners look forward to from Typhon, as well as where should they go if they want to learn more about what you guys are doing?
Sure. Typhon's website is typhoncapital.com. It's TYPHON. Typhoncap.com, I'm sorry. I think coming down the pike from Typhon, they're working on a couple different multi-strat programs that mix in volatility with some ag options vol programs. So it's kind of an exciting combination product. And, we're working on that V-Stocks European VIX Futures product. So we have kind of that in the pipeline as well.
Yeah, the V-Stocks is kind of interesting. It's kind of coming into its own, it seems like, these days. It'll be interesting to watch how that one develops. Head on over to the Typhon Capital site, listeners, to learn more and look forward to fun new strategy names coming to a prospectus near you sometime soon. And Mr. Greasy Meatball, you guys have a lot of arrows and irons in the fire over there. What's cooking in the land of Option Pit as well as Carmen Line?
Well, Carmen Line is continuing to trade. If you have interest, you can email me, mark@carmenline.com, carmenlinecapital.com. Option Pit, we're doing a webinar on risk management tomorrow at 10:30 Eastern time. That'll be after we've already, that'll be before this comes out. But we're doing a webinar on adjusting positions and managing risk on October 23rd, one of our Saturday classes. And you can go to optionpit.com/risk to register. Use code 25_off, off being all capitals, to take an extra $25 off. That's for Option Insider Radio people only.
There you go, listeners. And of course, if you do miss any of Mark's webinars over there, they do have that store there as well. So you can surf on over to optionpit.com and you can check out any of the ones you missed. Maybe you catch up on some of their volatility things or their options bootcamp. The name, of course, borrowed from our very popular options bootcamp program, et cetera, et cetera. A lot of good fun stuff you guys check out over there at optionpit.com. And on behalf of the Greasy Meatball and Mike of Lindsay Lohan, mullet fame, Tyson, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, subscribing, and of course, sending in such great questions. Keep them coming. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.